Whole life insurance has suddenly become a topic of interest in 2026. In the first quarter alone, whole life insurance applications spiked by nearly 30% in a single month. In fact, new premiums for whole life insurance didn't just grow. They smashed records, climbing 7% to a staggering $6.4 billion. The total policy count jumped 12% year over year. Who is driving this massive surge? It's not 20-something crypto day traders. It's applicants aged 40 and above. For Americans in their 60s, applications jumped by nearly 30%. For those aged 70 and older, a massive 46% surge. This is the reason whole life insurance has become a topic of discussion recently. Term life insurance is where you pay a premium for 10, 20, or 30 years. And when you die within those years, your family gets a big, fat check. That's right, you don't get a penny. Only your family does. But right around the time you feel like something might actually happen to you, the entire policy expires. Whole life insurance isn't all that different either. You pay premiums. You stay covered until you die. The insurance company pays your family. That's it. The same deal as term life insurance. So where is the difference? Well, first, whole life insurance does not expire the way term insurance does. It stays with you for the long haul, meaning you're covered for a longer period of time. Though, of course, you're paying premiums the entire way. Second, in whole life insurance, every dollar you send to the insurance company gets split into 3 entirely different buckets. Bucket number 1, the actual cost of keeping you covered on paper. Bucket number 2, fees and agent commissions. And bucket number 3, the cash value. This cash value is a savings-like vault that grows over time inside the policy. It's the feature whole life insurance agents and salespeople absolutely love to talk about, their favorite thing in the world. But the price of admission to this vault is where things get wild. If you're a healthy 30-year-old man in America, you can buy a $500,000 term life policy for about $30 a month. Simple. Cheap. But if you want that exact same $500,000 death benefit in a whole life policy, get ready to write a check for $400 to $500 a month. Yes, you are paying roughly 10 to 15 times more for the exact same payout. That massive financial canyon is where every single explosive argument on finance YouTube lives. So what are you actually getting for that extra cash? Well, that cash value vault grows at a guaranteed rate, tax deferred. The IRS can't touch it while it builds. You can even borrow against it tax-free, essentially using your own money as collateral to bankroll your life. But don't expect it to make you rich. The average annual return on this cash value sits around 1% to 3.5%. Meanwhile, the S&P 500 historically averages around 10%. If you treat whole life like an aggressive stock market investment, you lose. Every time. But whole life isn't trying to be an index fund. It's trying to be a boring, bulletproof, tax-advantaged vault that happens to include a death benefit. People mix these two concepts up constantly. Now, if you want to understand how the big players actually use this, you need to understand one phrase: a participating policy from a mutual company. A mutual insurance company has no outside Wall Street shareholders. It's technically owned by the people who buy the policies, which means once a year, if the company makes a profit, they share it with you in the form of a dividend. Now, legally, dividends are not guaranteed. The company could decide to give you 0, but the top mutual carriers have paid them out every single year for over a century. They paid them during the Great Depression. They paid them in 2008. They paid them during a global pandemic in 2020. MassMutual has paid a dividend for 158 consecutive years. In 2026, their dividend rate hit 6.60%, putting $2.9 billion back into the pockets of policyholders. Penn Mutual just announced a record $300 million payout at a 6% rate, a 10x increase in total dividends over the last 15 years. The people who obsess over this strategy take those dividends and use them to buy something called paid-up additions. This essentially forces the policy to compound mathematically over time, accelerating both the cash value and the death benefit. It is slow. It is predictable. It is mathematically consistent. The kind of people who find this deeply satisfying are probably also excellent at flossing their teeth twice a day. But before you call an insurance agent, here's the giant catch that almost every promotional video conveniently skips. Your cash value and your death benefit do not stack on top of each other. If you have a $500,000 policy and you spend 30 years building up $80,000 in your cash value vault, when you die, your family does not get $580,000. They get $500,000. The insurance company keeps the cash value. Go back and listen to that again if you need to. And if you decide to borrow $10,000 from your policy while you're alive and simply ignore the repayment, the insurance company will gracefully subtract that from your family's payout, leaving them with $490,000. Oh, and that loan carries an interest rate that compounds quietly in the background. If you let it run wild, it can eat your entire policy alive, lapse the coverage, and turn all that beautiful tax-deferred cash value into a massive, taxable income bill from the IRS. So no, it's not a scam. American life insurers paid out nearly $149 billion to families and policyholders in 2023 alone. These institutions are incredibly real, heavily regulated, and financially solvent. The product works. But whether it works for you is a completely different story. Let's look at what is actually happening in the American market right now, because the numbers from 2026 are wild, and they completely flip the internet debate on its head. While finance influencers were busy making videos, screaming that whole life is a trap, everyday Americans were busy writing checks for it. When you look at the entire U.S. life insurance market, whole life commands a massive 37% slice of the pie. Not term insurance, not indexed universal life, whole life. The exact product people love to aggressively argue about in YouTube comment sections is the single largest insurance product type in the country. Older Americans are panic buying whole life right now. But they aren't trying to build a complex corporate tax shelter. They are buying what the industry calls final expense insurance. It's a smaller, stripped-down version of whole life designed to do one simple, heavy thing. Ensure their kids aren't stuck paying $10,000 to $20,000 out of pocket for funeral costs and medical bills. These final expense policies are small, usually between $10,000 and $25,000. They don't require a brutal medical exam, making them easy to qualify for. In fact, about 23% of all Americans who look at life insurance are doing it primarily just to make sure their burial costs are covered. It's practical, it's emotional, and it is a massive industry. But what about the wealth building side? Why are the premium buyers flooding in? Because 2026 is delivering some of the best dividend performance we've seen in decades. When interest rates spiked over the last few years, the average person panicked about their mortgage. But insurance companies quietly smiled. Insurance giants invest your money into massive portfolios of high-quality, long-term bonds. As their old, low-yielding bonds mature, they are reinvesting those billions into 2026's higher interest rate environment. The results are flowing straight back to policyholders. MassMutual's dividend rate just hit a historic 6.60% after 3 consecutive annual increases. Their total dividend payout reached a record $1.7 billion, double what they paid just a decade ago. Penn Mutual announced a record $300 million payout at a 6% rate. If you already own a well-designed policy, your cash value growth is getting a massive, turbocharged boost right now. So let's weigh the scales completely honestly, without any agenda. The real pros. First, bulletproof permanence. You cannot outlive it. If you buy a 30-year term insurance policy at age 35, it expires when you turn 65. If you want a new policy at 65, your health is worse and the cost is astronomically higher. Whole life stays active as long as you do. Second, guaranteed, predictable growth. When the stock market drops tomorrow, your cash value doesn't care. It goes up every single year. Predictability is a premium worth paying for when you're nearing retirement. Third, the tax trifecta. Growth is tax-deferred. Policy loans are tax-free. And the death benefit paid to your family is completely income tax-free. Fourth, the asset shield. In many U.S. states, your cash value is completely protected from creditors by law. If you're a surgeon, an attorney, or a business owner operating in a high-liability world, this is a financial panic room for your wealth. But now, the brutal cons. First, the cost. You are paying 10 to 15 times more for those guarantees. If your goal is raw wealth accumulation, your money will almost certainly perform better long-term in a boring index fund tracking the S&P 500. You are trading maximum returns for absolute certainty. Second, the early years are a wasteland. In years 1 through 5, upfront fees and agent commissions eat almost everything. Your cash value grows at the speed of molasses. If you panic and cancel the policy 3 years in, you will walk away with a significant financial loss. Third, the agent trap. A poorly designed, basic whole life policy sold by a pushy agent deserves every bit of criticism it gets online. To make whole life truly efficient, it has to be custom built using complex insurance riders to maximize immediate cash value. Most consumers have no idea how to spot the difference. And fourth, the shorter pay pressure. Because interest rates are fluctuating in 2026, the industry is shifting aggressively toward limited pay structures. Buyers are flocking to policies designed to be fully paid off in 10 or 20 years, rather than paying until age 100. It gives you a clear endpoint, but it means your monthly premium check is going to be incredibly heavy, and all of this data creates a very strange contradiction around whole life insurance. Because many of the exact same financial experts who publicly trash the product online will also quietly admit that certain wealthy families still use it. A lot. But they aren't buying it because they expect mind-blowing investment returns. They do it because the ultra-wealthy think about money in a completely different way than ordinary investors do. Average investors focus almost entirely on growth. Wealthy families focus almost entirely on preservation. That changes the entire conversation. Once you already have capital, your priorities shift. Suddenly, tax efficiency matters more. Estate transfer matters more. Liquidity matters more. Guarantees matter more. And protecting your assets matters most. Whole life insurance was built for exactly that kind of thinking. This is the real reason the product refuses to disappear. It's not because it's secretly magical, and it's definitely not because every policy is a good idea. Let's be real, some of them are genuinely terrible. But the internet loves to oversimplify complex things into a clean, easy verdict. Whole life insurance bad. Reality is a lot more uncomfortable than a thumbnail headline. The product survives because different people are trying to solve entirely different financial problems. If you're a 25-year-old software engineer trying to aggressively maximize long-term stock market growth, whole life insurance makes almost zero sense for you. But if you're a 55-year-old business owner worried about corporate taxes, passing an inheritance to your kids, market volatility, and shielding your assets from lawsuits, the mathematical calculation looks completely different. And that difference became a lot more obvious after the economic mood in America shifted. Over the last few years, Americans have become hyper-aware of just how fragile financial stability actually is. A good salary no longer guarantees security. A stable industry no longer guarantees a job. Even homeownership, which used to be the ultimate American symbol of safety, increasingly feels expensive and unpredictable. And once people start feeling economically vulnerable, their behavior changes. You can actually trace this exact pattern throughout American financial history. During optimistic economic periods, people speculate. During fearful economic periods, people protect. That is the exact moment guaranteed financial products suddenly stop looking boring. Even the language we use around money changes. A few years ago, the internet was completely dominated by words like growth, scaling, aggressive investing, and crypto millionaires. Now, the tone feels entirely different. People are talking about stability, protection, backup plans, emergency vaults, and guaranteed income. Whole life insurance fits directly into that psychological shift, because despite all the heavy criticism, it offers something modern financial culture deeply struggles to provide: predictability. The policy does not care if the stock market crashes next month. It does not panic when interest rates change. It does not suddenly disappear because a tech company laid off 12,000 employees on a Tuesday morning via Zoom. It just sits there quietly, collecting premiums like a financially conservative turtle. And for anxious people, that predictability can feel emotionally invaluable. Does that mean the product is automatically worth buying? Absolutely not. And this is where things get incredibly dangerous online, because discussions around whole life always swing between two ridiculous extremes. It's either, this is a toxic scam, or this is the secret wealth hack banks don't want you to know about. American finance culture absolutely loves turning complicated financial products into Marvel movies. In reality, whole life insurance is neither a miracle nor a scam. It's just a trade-off. You are consciously sacrificing higher potential investment returns in exchange for guarantees, stability, and permanence. Whether that trade is worth it depends entirely on the person writing the check. Financial decisions are deeply emotional, far more emotional than any spreadsheet admits. Most people don't build financial plans using pure mathematics. They build them around fear. Fear of becoming a burden to their kids. Fear of economic instability. Fear of leaving their family unprotected. And in 2026, those fears are becoming far more visible across America. Nobody has ever woken up excited to compare insurance premium structures at 7:30 in the morning. The deeper reality is much simpler. When people trust the future, they chase growth. When they stop trusting the future, they start paying for protection. And right now, America looks increasingly like a country searching for protection again. But is the actual math of infinite banking worth the incredibly high price of admission?